Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, May 10th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we have an interesting episode lined up for you, a little bit of an educational episode. One of the first topics that we're going to touch on today is just a general perspective on the market and what I kind of think is out there and my general feeling. Nothing too insightful, just my own thoughts on that part of it. Then we'll move into, can we have our money work for us? And after that, we're going to touch on market makers. And this is the headline topic in this week's episode. If you can be a market maker, you should be a market maker. But before we hop to that content, I want to give a shout out to our Discord, link in the description below. You can click in there, say hello to myself, Viper, several of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to see. Additionally, you can go to thetagang.com/sprocket888 where you can see each and every one of my trades, the good, the bad, and the ugly. You can also pick up this episode in an audio-only format wherever you get your podcasts. But let's hop to this week's content, Viper. Viper, the market perspective. That's what I kind of want to touch on here first. And, it's been an interesting ride in the market as of late. I wouldn't say that we're incredibly bullish, but we have largely stemmed the massive slide that was all of 2022 for the most part. And I really feel like a lot of the trades are starting to make more sense to me. Everything, panic is starting to kind of come down. We've had a little ups and downs and flurries, but there's always little pockets of the market that freak out or kind of get your big price gyrations. But I don't know about your perspective on different equities and things that you've been kind of trading, but a lot of it has been returning to more that 2021 feeling of my trading, where I seem to be hitting a lot of my trades lately as far as the thesis lining up. They're playing out the way I want them to. I starting to kind of return to some of the older percentage win numbers that I used to have. And I kind of equate some of that to in 2022, yeah, the market slid all the time, and I was really just scared to grab the bearish trade for fear of like a whipsaw action back. And so all of 22, I actually carried pretty long deltas. So I'll put a link up above to our episode just recently about knowing your delta and knowing your risk. But I'd say as of the past month and a half, I've really kind of focused back to that core, stay delta neutral, collect your theta. And, that was my recipe of success in 21. And so far in a few weeks, I'm feeling it's coming back here. I don't know, Viper, if you have any thoughts on the current macroeconomic picture or the equity market. I know you dabbled briefly, but that's not really where you've been hanging out most days lately.
Yeah. I feel very similar from what I have been doing or paying attention to. Because like you said, I'm still somewhat distracted, still doing the auto index ETF buy-ins, stuff like that for equities, for exposure to the current market. But spending a lot of time exploring these things that like we're going to talk about here in a minute. But one thing I do watch a lot of is the SPX, and, just to keep the finger on the pulse. And so I am feeling we're at like around 4,100 level, and that has been a level that I've charted for a while as a pretty important level. And so that's kind of my real quick, rapid, litmus test of how are things looking is what are we doing around that level? And we haven't sufficiently gained it and confirmed support to really start tearing off of it, but we are doing some pretty nice little swings around it, and certainly not in panic mode rejection of it. Like you said, that things are feeling a little more quote unquote normal. So stay tuned for next week where we recap the Black Swan event that happens right before this video airs.
Yep, the calm before the storm.
But yeah, in general, some of the plays I've made, have felt less, worrisome or less like, I don't know if it's going to go up or not. Like, just more confident, I guess is the word. But I'm looking forward to get some stronger directional. Like, I mean, I feel like in the grand macro scheme of things, this transitional market is where it's just, yeah, it's, you just wait. It's this crab sideways stuff that makes you got to hunt a little bit harder than when you're in a strong directional market, like down where we just were. When we eventually get back to a bull and we are up and to the right, and trades become easier when it's directional.
Yeah, the directional stuff though can at least directionally up. That can give a lot of false confidence, I think, in traders because you can throw a lot of money at things and pretty much a lot of it'll stick and just carry up.
Yeah, I mean, precisely where at least and I think you partially entered. I know I experienced a lot of that. That 2020, late 2020, early 2021 was, man, I'm pretty good at this.
Yep. And you see like all the young retail traders, or I shouldn't even say young, just retail trader numbers go up at all these brokerages. And then it was pretty fun to read all the stories of all these, TD Ameritrade, Schwab, E-Trade, talking about how their retail numbers are just plummeting throughout 2022 because the retail trader was getting very discouraged by their performance because all of a sudden it mattered what you bought.
Yeah.
Because some things you bought and you just went down.
Yeah. And I mean, and a little more seriously, like, I mean, that's why, for better or worse, and I think it will be for better on a longer time frame, I've really some days forced myself to stick it out the past, over multiple times over the past year, both in equities and over in the world of crypto, because, there's just something about, like we always say, with as long as you're risk mitigating, as long as you're positioned, all that stuff, there's just something that you don't learn in the books. You don't learn reading other people's experience of, like, being in there, feeling the feels, and, just touching it and knowing what the pain feels like. And it's also, I feel like it's made me better on a bigger scale because I've put a lot more value through my position sizing, through knowing that every trade I make, this might not work out, sort of thing. I've put a lot more value into what is happening, what the investment is, or things like that. And so I think it has had a decent positive effect that, will play out over the years to come. So if you find yourself in your first bear market ever, stick it out, but be careful.
Yeah, well, that's kind of a lead in here to the next thing that we're going to kind of talk about, and that's really kind of making the money that you have work for you. And I'm not going to go through all of this. Oh, you just got to make your money work harder than you. But it's really, if you go back in our episodes and you look about the things that I get excited about that we talk about, I'm excited about the topic today of market makers because it fits this thesis, this style, this flavor of trading that I like. And that is find a niche of a way to trade that basically removes the directional bias from your trading. And so a couple examples that we talk about all the time, right? Premium selling, balancing your deltas to keep delta neutral, selling the theta, right? In that whole world, you're basically being the insurance underwriter for holding this risk with this high probability of making money. And you get to go on about your day job because you don't need to monitor this thing every waking minute of every waking day. And, that also led into our discussion on being a crypto validator node, right? We equated that to Visa transactions, right? The people that at Visa collects a transaction fee. It doesn't matter whether the economy is good, bad, things like that. As long as people are buying things and transacting, they're making money. And that AVAX validator that, you've heard me talk about working towards, or any crypto validator for that matter, It doesn't matter whether that particular token is going up, down, left, right. As long as people are trading the liquidity pools, you're getting paid to provide that liquidity. And so that is the type of stuff that I'm really interested in. We talked just like 2 episodes ago. If you can be the bank, be the bank. So how decentralized finance brings in this interest rate arbitrage opportunity. Borrow at one rate, lend at another, and you can profit on the net interest margin, the difference between those. It doesn't really matter as much about what's happening in the market, what's happening on there. It's a set it and forget it type environment if you set it up right. And that's the type of stuff that I look for when I'm looking about how to trade, how to make money on the short term, because I'm trying to create an income stream separate from my day job. But my time is valuable. I don't want to spend every waking moment from 9:30 a.m. to 4 p.m. staring at charts on a screen and figuring out when to buy this or sell this. And that's just my style. I think that resonates a little bit with Viper, although it tends to be, I think, a little bit more hands-on when it comes to that stuff. But
Sort of. It's a process. So, but I mean, in general, I agree. Like, I mean, there's days where I'm like, man, this is fun. Like doing more day trading or when things are volatile or whatever. But yeah, there's more often than not, it comes down to like, this is also exhausting. And I just spent how much time trying to do this. Yeah, on today's topic, there was a whole chunk of time that I'll talk about where I gave it this much thought, this much effort, and it did good things for me. So that's also really nice.
yeah. So let's kind of move over to this topic of if you can be a market maker, be a market maker, because we really haven't talked about this type of thing on the show before. And so I kind of want to start off with a little bit like, what the heck is a market maker? Because you might hear those phrases and you might think, oh, those are some elite capitalist guru people with buku amounts of money that are just out there to squash the little guy and make him feel pain. And well, that's not entirely true. Let's just take a look here of what is a market maker. And Investopedia is just one of those places that just has pretty good definitions and cleanliness and descriptions of things. So I'll just kind of defer to them and say the market maker, it's written right there, a firm or individual who actively quotes two sides of a market in a particular security, providing bids and offers known as asks along with the market size of each. And you think, okay, what the heck does that mean? And so if we can just kind of picture a marketplace, street market, selling chickens and fruit and apples and whatever, the market makers are basically the people that are offering up and filling orders, basically making the market. Without people to buy and sell, there is no market. So a market maker's job is to basically offer up goods for sale or for purchase. Where, a particular equity, let's just take Apple for example. And let's say somebody wants to go buy Apple. In order for somebody to go buy Apple, somebody has to be selling Apple. And that's the job of the market maker. And the job of the market maker is to say, hey, I will sell Apple for $100 if that's a fair price for Apple. And then that market maker might say, well, I'll buy Apple for $99.50. And where they make their money is the arbitrage or the difference between that bid and the ask. And so I've got a couple of screen grabs here of two order books. And so price is declining as you go down in both of these. Each of these have a different number of volume and a different amount of market makers available. So this one here on the left that's in the 110 ranges doesn't have a lot of bid and asks, and they're pretty far apart. This red number are the people trying to sell, and each number represents 100 shares. So somebody up here is trying to sell 300 shares at $110.16. Someone here is trying to sell 4,400 shares at 110.09. Now the greens are people trying to buy. So here's 100 shares will be bought for 110.03. And what the market maker does is he tries to split the difference between these. And so he'll try to buy the orders down here and then turn around and fill the orders up here. Kind of flipping that the difference in there. So they don't make a ton of money on each transaction, but the idea is they make a lot of transactions. In this other order book, you can notice that these price ticks are a little bit closer together and a lot more orders. So this is a lot more liquidity in this particular underlying. And so a market maker can typically plan or to basically make the difference, half the difference between the bid and the ask. So if you have a particular market that is really wide, one, it means there's probably not a lot of market makers there, because the more market makers, the tighter up that spread gets, the more liquidity it gets, because each person is trying to undercut the other market makers. And that's what helps bring fair pricing to markets. And that's why when we go to trade, we say, look for liquidity. Liquidity is king. Without liquidity, you're going to have what's known as slippage. You could be getting an unfair price. When there is high liquidity, these market makers are basically undercutting each other, forcing that spread to get very, very tight, which means you're getting a fair price. And that's always why people say markets are efficient, because they're designed to naturally, as long as there are market makers present, naturally gravitate the market to whatever the fair price happens to be. If price gets really crazy, nobody wants to take and fill those orders, so price discovery will bring it back into line. And you can think of two aspects of trading. There is market makers and market takers. We kind of talked a little bit about those market makers being the people that are providing that liquidity, filling the orders. Typically, what we normally talk about on this show are, I bought this, I think this is going to do this in the long term. That all is market taking. So those are the people that are showing up to the marketplace, and they need somebody to be buying and selling things so they can pick and choose and say, I want this thing and I want to buy it, and I'm going to hold it for 4 weeks or until it rises up to some much higher price. Those are your market takers. Those are the traders. Those are the investors, the producers, the consumers. And the market makers are the people that are just trying to bang, 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 buy from one guy over here, turn around and sell to this guy over here. So they don't really want to hold any of these positions any more than a matter of seconds or fractions of seconds in automated market making world. And their goal is to get money off of that arbitrage, the difference between that bid and the ask. And that's really kind of the definition of what market making is all about. Every type of market needs a market maker to bring liquidity, because like we mentioned, if you don't have liquidity, people aren't going to want to show up and participate in the market. So these centralized exchanges, these centralized firms, even potentially the decentralized things, which Viper is going to talk into, they need to incentivize market makers to come to their market, because without market makers, you won't have a market. And so there's different forms of incentive that basically help try to prod the market makers to be present. Once a market starts, it's like a snowball running down a hill. Once it gathers up enough steam, it kind of then can draw its own interest in it, right? So once you get enough people trading on a particular exchange in a particular area, that place doesn't have to offer as high of incentives, because the market makers can come in and make money on the arbitrage, knowing that it's a popular spot. So people are going to flock there as the hot spot to go to buy and sell things. But when something is just starting out, it's going to entice the market maker to be present. There has to be some type of extra bonus reward or incentive for that market maker to put his risk in that market, because they are at risk, because they are buying and selling these things. And if the market completely evaporates while they're still kind of holding their stuff, that's the risk that the market maker is taking. So Viper, I'll kind of toss it over to you to start chatting about what the heck have you been doing in market maker land. And it's knowing you, it better not be in equities. It must be in crypto world, right?
Yeah, I have I don't have a secret life as some billionaire hedge fund doing equities market making. Yeah, so there's a there's a couple things to unpack here, and I'll try to do it as gracefully and quickly as possible. We've obviously talked a decent amount about liquidity, so now we're shifting gears away from equities and we're going into this decentralized world, which means that we need to do the disclaimer that we are going into the unregulated zone. We are going into the wild, wild west, and the being in here is, like Sprocket was saying, that there's so much interesting value and opportunity in this world of decentralized finance. However, it is very unfortunate that you can't just jump into something that sounds great. So anything we talk about, as always, is not an endorsement. It is not something that you should just go jump into because you saw Viper doing it or you saw us talk about it. This stuff is, I do as much due diligence as I can. I read contracts and security audits as much as I can. That still doesn't mean I'm picking winners. And in this case, it's not just winners of a position, it's winners of the entire thing, the entire protocol. And therefore, I am heavily risk mitigating on position sizing and all that good stuff. So just needed to call that out because there will be some protocol names and things like that in here. So you've heard us talk about liquidity pools, and that's a really cool mechanic. That's a really interesting thing because it's just open trading. There is no particular need for a market maker per se, because in a liquidity pool, you have two assets that are valued linked to each other, and they each carry their own value. So when the pool gets lower in one, it changes the value and the ratio and all that stuff. There's a ton of arbitrage in liquidity pools because one pool may be imbalanced, and so arbitrage bots go and rebalance, and they make a profit on that. So it is sort of market making, but that's a little bit different in the mechanics of it. So there is a particular protocol that has popped up and significantly caught my attention because it's a CLOB, it's a centralized limit order book, but it lives on a decentralized platform. And so what that means is it works just like we, expect from an equities market. It's a limit order book. It's an order book of bids and asks. And therefore, in liquidity pools, you have things called slippage, where you went and you accidentally bought a bigger portion of the pool. So not only did you bought it at the price, but then you also had to pay your price impact, and that's called slippage. In an order book, you don't get that. In an order book, you say, I want to buy one AVAX for $15.50. And then if there's nobody selling it for that, then you just wait. And somebody shows up and says, I will sell it to you for $15.50. And there's no slippage or anything like that. So this thing showed up and there's plenty of centralized exchanges, which you've heard us talk about a lot. And they do order books. So your Coinbase, your KuCoin, they do order books on their platforms. However, that is centralized, and in this wild, wild west, in the world of FTX and things like that, we're just very averse to centralized exchanges at this point. I use them to get on and off, but I don't like to do my trading there because there's also not this level of DeFi on those platforms. So this thing showed up. It's called Dexalot, and it is we could jump over and it looks like a centralized exchange. You have your order book over here, you have your trading pairs over here, except this is decentralized, meaning that it is run by smart contracts. There is no there is an entity that develops it and develops the contracts and things like that, but the liquidity in the market is all in smart contracts and not under the custodianship of any one particular entity. I have full custody of the funds that are on this platform. I never release that control to anybody else. And so that piqued my interest when I heard this thing was coming out. And so, however, it also means that it is subject to the market effects of being an order book, which is to say, you need people making the market, you need people filling the books, you need people, that come in and want to trade to know that their order is going to get filled. Otherwise, they're not going to come trade here. And then now we're stuck in this paradigm of, well, nobody's going to come trade because they can't fill, and that, you don't have anybody filling it. So that's the struggle of such a platform, is you need to incentivize people to put orders on the book. So I say that to explain how there's this blue zone and this black zone. And so there's a rewards program going on where if you have a limit order sitting in this blue zone, that is incentivized, and there are rewards that get paid out the longer your order is sitting in here. And then there's tiers of it where the closer you are to the strike, which is the middle here, currently 1548, the closer you are to that, then the higher value your order is, because you're helping really now provide that liquidity that the protocol needs to be liquid to somebody to come in and just trade. So this opened up the opportunity then, because anybody can come in and interact with this. They have APIs opened up, and I have found a open source trading bot that can connect to this particular protocol, and I can configure it to go ahead and drop orders into the order book. And then every so often I tell it, okay, now reevaluate. And you kind of keep seeing that pop up on the screen. You'll see order canceled, order created. And that's essentially what I'm doing. Is these yellow dots are orders that I currently have, and what I've told the bot to do is to come in here and open up 4 orders, 4 sell orders, 4 bid orders, and 4 ask orders. So 4 sell and 4 buy, and I told it to space them out such that the first order is 0.1% away from the strike price. So I wanted that first order to be right there, coupled in close, right up to the strike price. And then I wanted the next few orders, the next 3 orders, I wanted to space those out. So I have first order opens up at 0.1%, then 1%, then 2%, then 3% away from the strike price. So we'll see here, order created, it pops in, and you can see the first order super tight. It's a current strike is 1549, first sell is 1550, first buy is 1547, and you can see we space out all the way up to the top of the reward zone here. So the purpose of that, now I'm serving that. Now, that's it. I'm a market maker. I'm coming in here and I'm providing liquidity where it's most needed, but I'm also trying to hedge my position a little bit in how this bot is operating so that I don't, suffer a ton of loss. And so what I mean by that is I currently have it set up to say, okay, every 5 minutes, I don't care what's happening on the books, I don't care what's happening in the price, clear all the orders out. And that's why you occasionally see order canceled. I say clear all the orders out, reset yourself, and do it again. 0.1, 1, 2, 3. So in the event that the price starts moving in one strong direction, in theory, and this is something I can tweak if I need to, because right now that 5 minutes is totally programmable. I can change it to whatever I want. But in theory, as the price moves down, I constantly keep a buy order, let's say at least that 3% one, I constantly keep that floating down ahead of the price, so that if there is ever a dramatic shift in price, I have a good buy order sitting there ready to get filled on it. And that's not a perfect hedge, but it's just tickling the mind as far as things that you can do in market making. So where you focus on being the liquidity provider to the market. And in this particular case, I'm banking on most of my benefit coming from the rewards of the rewards program. If the rewards program didn't exist, and for all intents and purposes, you should assume there's not a rewards program, because, this is a unique situation of something trying to really attract that liquidity, I could easily do this same thing, and I could incorporate a different hedged bot on a different exchange. So just real quick, I want to show that arbitrage that Sprocket was talking about. Right now, we can see this this particular market has a very wide spread. I mean, the orders are jumping around a little bit, but our first sell book order here is $15.49, and our first buy is $15.47. So that's a really wide spread, a 2-cent spread, as you can see over here. And if we go to a highly liquid market, so we jump over here to KuCoin, which is a centralized exchange, and this protocol has let's see, in the past 24 hours they've done $5.8 million worth of volume. So I thought there was a pool size or liquidity size, but there's not. But if we look at this order book, you can see the first sell order is sitting here at $15.48 and the first buy is $15.479. So it is a super tight spread compared to what we have over here. So that's just to say exactly what Sprocket was saying. The more market makers that show up, and in the case of KuCoin, I don't believe no, you can be market maker. You can run a bot and be a market maker in KuCoin. They have that competition. Over here, that competition doesn't quite exist to that degree. So if this reward structure didn't exist, I could still make a lot of trades and make them profitably, because you can see here the arbitrage opportunity of this widespread that I could make a buy or I could make a sell, and then I could immediately go do the opposite over on the KuCoin market and hedge that position and lock in that small profit, and then just do that a lot of times per day.
But even to just not get into switching different markets in different places, potentially with a spread this wide of your first buy and your first sell, you could just cut that by a half a penny, and potentially get filled. So that's why those things get tighter and tighter, because your market makers will come in and they'll say, oh, here's this spread. I want to buy and sell real quick, bang, bang. So they'll undercut the buy and they'll undercut the sell to basically jump to the front of the line, right? People are not filling at the orders that Viper is throwing out there because they don't want to execute on that. And so what you do as a market maker is you come in and undercut, and then you get the transaction to go through, and now you got to flip it over to the other side real quick, undercut, fill it, and you do that enough times, and that's where the market maker makes their profit.
Yeah, absolutely, and you probably saw it here on this wider spread order book. When my orders go in, right now we're in a cycle, a refresh cycle. But when my orders go in, every now and then I get undercut, as the price moves or whatever, a new order pops in. And that's exactly what Sprocket's mentioning there. So how does this all play out then to this idea of passively partaking here? I think I still have it up on my chart. I do not. So, we'll just sketch it out real quick here. So this is obviously the pair that I'm doing this on is AVAX USD. So over the past 24 hours now, we are roughly in this box of price action on the underlying. And so you can see we've been fairly sideways. We've had a spike up. We had a big dump down and then quick rebound earlier today. But in this box, this is where I've been running this bot. And key to this whole thing is, like we were saying earlier, I've been doing zero manual effort to this. I mean, there are some things on the technical side I'm checking in on just because, I want to make sure everything's running smoothly. But from the trading perspective, largely I'm just letting this thing go. And it actually performed very nicely in this little volatility we had here. I was very happy to see that. But in this whole thing here, the the value of my portfolio that I'm using to do this has changed maybe by less than 0.5%. And it's done almost $3,000 worth of volume. So it's not just sitting there. Like, it is executing these fills, it is filling the book, it is doing more, and on almost $3,000, which is a solid. Oh man, I don't know. Math is hard, but so I started with like $650 in the portfolio. So I mean, that's a significant jump over 4x of volume to the capital, and I've come out with, like I said, less than 0.5% of portfolio value change. And again, that is by design, because I want to capture the rewards, the incentives that are in place for me providing that liquidity. That's the current play in this situation. Like I said, I could tweak the bot and then actually make those trades a little more profitable. But at this point in time, I don't really need to do that. And none of that is to say, look at these profits I'm making, but it's just saying this is a passive play that's harvesting this incentives that are out there to provide liquidity to this market. It's giving the market a service where people can show up and trade. And it's doing it in this decentralized world where, just like on the previous episode, we talked about being the bank. For now, we'll see as, regulation continues to shake out. But for now, the common man can or woman can show up and provide this service and get rewarded for it. That is something you don't get to partake in for a number of reasons in a more traditional market. So, looping back around though, that is not, like I said, we pound the table on it, and maybe it's annoying, but I need to say it that is not an endorsement or green light to just go dive in. But more than anything, it's just the concept of what is happening here, that is far beyond Dogecoin or sheep to the moon. There's all this stuff being built that I think is very interesting to partake in. So I do want to ask, then bringing it all the way back. I mean, I guess I kind of asked you this before, Sprocket, but you were so early on Bitcoin, obviously, like we've talked about, 2011, 2012, whatever that was. I mean, this, I'm not going to say, is this exactly what you envisioned, but still, like, what drew you to it then? And just kind of how things have played out, how things are developing and whatnot, versus what initially drew you to interest in this space.
Well, I'd say that I guess nobody could ever envision what would come, right? With any new technology, you're like, okay, everything is always so short-sighted. I think look at Chat GPT and all the AI stuff, which one, I'm never a fan of the latest buzz of this, that, and the other thing. But people make all this speculation about what will AI do? What will AI do? And you got one people that are pretty sure Skynet is coming. You got the other people that are pretty sure total automation and the disruption of all educated persons are at risk, because now any dummy can get stuff. But in reality, that's not usually what new technology brings. And so going back to the whole advent of Bitcoin, the thing that drew it to me the most, that I was most excited about, was the fact that for decades, hundreds, thousands of years, the way that society was often controlled by any entity was through various means. One of those was the ability to print and manage currency. Everybody needed currency to trade things and stuff like that. And when you centralize the power of that currency with any particular government, entity, organization, doesn't matter whether, what the political ideology is, it's the whole premise and concept of kind of controlling that currency, controlling a lot of influence over a particular society or the people that value that currency. So what Bitcoin, to me, forever ago, what now, 15 years ago, something like that, was the kind of promise that, hey, some of these age-old ways of thinking and ways of doing things could be brought into question, because there was this way to decentralize and shift the control away from a centralized entity, whether that be a good entity, a bad entity, it doesn't matter. It was still a centralized point of failure. So yeah, this is really bringing more of a democratized approach to finance and stuff like that. And so a lot of this stuff is exciting to me. I'm still a little cautious on some of these things, and I think the right approach is position sizing and stuff like that, because this is distributing that ability. This is bringing openness, transparency, and I suspect, and it is kind of shown, that a lot of those organizations that are akin to kind of controlling things look upon this at first as, it's a joke. It's a joke. Nah, nothing's ever going to come of that. And then that transitions to, oh crap, something's happening here. It's evil. It's bad. It's gonna destroy society. And eventually you move into the phase where it becomes more mainstream and more people adapt things to it, and you start putting regulation and you start living with it, basically. And I think we're kind of in between that phase of, this is going to wreck the world, and here's how we're going to put some guardrails up and let this thing grow and flourish and see how it comes to be. And I guess that's exciting. I don't know if this is what you actually asked me, thinking back to it, but I think that's just my perspective on how all this kind of lines up.
Yeah. I mean, I think that definitely fits the bill, because, I mean, it shows that even though, like you said, nobody can predict the future. I mean, especially, like, even today, we can look at the last 10 years that we've had with the development and momentum of the Web3 crypto space, and you still can't predict what's about to happen next. But it does definitely answer that. It was that central ideology of that democratization and that distributed nature of the thing. And I mean, in this case, like, we just break it down even further than a currency or anything. Like, it's the distributed nature of something that has never been able to be distributed before. And so I'll be generous enough to say that there was no need to have distributed banks or current, all these things. But now technology has come along to a point where it's possible, and there are a lot of benefits that can come along with that. And so I think that certainly rings, at least to me, a theme throughout what initially drew you in, how the space has evolved, and what's keeping you interested going forward. And I completely agree that the future is not the what some would view very dystopian and some people would view very utopian, as far as like power to the people and there's no governments, and like, I mean, that's not going to happen. Regulation will come in, and like you said, we'll learn to live with this and adapt the technology into modern services, and those powers that be will find a way to get their grasp on it. And if anything, you can wire transfer money a little bit faster than waiting 5 to 7 days, something like that. But it'll be interesting to see where that merge point happens and what happens. I'll be super happy if I can continue to participate at this level. But again, that's part of those regulations, and we'll see what they decide can and can't happen here. But it's interesting no less.
Yeah, I just want to know what happened to my 3D TV. Remember? I mean, all TVs were going to be 3D. Whatever.
Yeah, that was all the rage. And I think, didn't you have one for a little while?
Yeah, but not on purpose. I needed to buy a TV, and the only type of
That's how hard they were trying to shove it. Was here. This is the best offer we have as a 3D TV.
there was never anything to watch. I think I found like one bit of content that was.
Yeah, I can say safely that I never experienced it, and I don't feel like I missed anything. I do enjoy the 3D experience at the movie theater when the screen is, massive and you can get engrossed. But yeah, let's maybe think this is shaping up to be a little more than a 3D TV. And one last thing, which I think is super cool in this, idea of decentralized systems or, services and things like that. This trading account that is doing this market making is currently funded because I took a bag of assets that I'm holding, and we talked before about being the bank and lending these lending protocols and things like that. I actually took that bag of assets and staked it into one of these lending protocols where I'm lending those out to people to borrow and earning a small interest rate on that. And then I can borrow against that. And so I borrowed against that to bring that, over here to fund this little trading adventure here. So it's kind of, a twofer on what I'm earning out of that initial bag of capital. But we say all the time on investments and things like that, know the mechanics of the thing you're doing, because that taking that loan out against my assets, that's leverage. And that means I'm exposed to liquidation risks. And so I have very, thoroughly understood what risks are at play for me in that. And I know what to watch for and how to mitigate that to not get liquidated, to not have this thing blow up in my face, et cetera, et cetera. So I just want to call out, don't just run it like everything. Don't just run in like, oh, I could put money here and borrow against it. And yeah. But I thought it was kind of cool as far as connecting all these little pieces and parts. And as long as you thoroughly understand what's happening under the hood, that's a very important piece to having that comfortability. I think to me, that's a big part of what keeps me so interested in exploring this space. Is just, it's hard to describe, and it's an eye roll to somebody who's never experienced it, but just the feeling of control and ownership over what I'm doing with my money in ways that it's not possible to be done anywhere else, is just a really cool feeling and experience. And I'm still continuing to do it on smaller portions that, honestly, that's why I want the regulation and the rules to come in. Give me the FDIC insurance and give me some sort of comfort here. Otherwise, we'll just keep exploring on these smaller amounts.
So that brings us to the end of this week's episode. Like I said, this is a little bit of a education on what the heck is a market maker, which is applicable to all free markets and open exchanges, not just crypto things. Crypto brings an interesting spin on that, where you can basically take and run things your own. It's that whole distribution of control to individual participants and things like that. So it was kind of interesting to see this bot play out. It's something I might check out, because I'm always interested in kind of, hey, how can I run this myself? How can I do this myself? How can I participate in something that is providing a service that others find value in? I can get compensated for that service I'm providing, or that risk that I'm taking, that allows me to have that separate stream of some kind of income that is passive. It doesn't take a lot of my time beyond setting something up, learning something, things of that nature, because your time is valuable. And the commodity of trying to work harder, work longer to make more money only scales so far. And when you really kind of look at true wealth building, the people that are successful in that, they don't just have a job that they work at every day, right? They have a job. They have a income stream for X, a income stream for Y, an income stream from Z, right? They build all these things in to kind of diversify their income, right? You diversify investments, you diversify your exposure to reduce risk. Why not do that with your income and your savings, to bring more flexibility and more financial independence into your life? And so any one of those technologies, I'm always all about. I want to learn more about it. What are the risks? What are the gotchas? There's no such thing as a free lunch. There absolutely is a risk in all of this stuff. And so we don't want to ever kind of portray it as everybody should do this. It's free money. It's risk free. Nothing is risk free. Nothing is free. Everything comes at some type of cost. And just kind of understanding that it goes back to the knowledge is power. Understand what you're doing, understand the mechanics, what makes the machine tick, what makes the machine go whir. And yeah, I hope you learned something. We kind of love to venture out on some of these things. And so if there's any particular technology or something where you're like, wow, what's going on? Leave a comment below or hop in our Discord, ping us in the Discord. We usually hang out in there sporadically throughout the trading day and even after hours. I end up being in there more after hours than during the trading day just due to my availability of things. But yeah, check it out and get interested in something. There definitely is something out there that will interest you. I promise. What it is, I don't know. You have to find that and explore it for yourself. But good luck out there. And remember, think outside the block.